Hi, I'm Linda Eedes. This is an update on the RECM Equity Fund, looking specifically at the first quarter of this year, looking at what drove returns, some of the changes in the portfolio over that time, and also how the fund is currently positioned. So the first quarter of this year was quite a buoyant one if you look at the overall index. The JSE All Share Index was in effect up 8%. The fund, by contrast, was actually down 1.5%. Now, you'll probably recall that our fund tends to zig when the market zags. It's one of the reasons why the fund was one of only two funds that posted a positive return last year when the market was down around 10%. Our fund is much more domestically focused, and that is where we believe the value lies in the more sort of industrial businesses, the South African incorporated type companies. And the All Share Index was driven by a very small number of large cap, more rand hedged stocks, such as Naspers, for instance, which was up 19%, Richemont, which was up 12%, some of the resource stocks and the like. So if you actually look at the top 5 stocks of the All Share Index, that actually drove 90% of the 8% return for the quarter. So digging a little bit more deeply, the local situation was not really represented at the overall index level. So it follows that the contributors to returns in the fund were stocks such as Impala Platinum. After a long time languishing in the doldrums, platinum producers do seem to be showing some life in terms of their share prices. And Impala Platinum was in fact up 66% during the first quarter of this year. Of course, some of the other resource stocks has contributed as well. And then stocks such as Richemont, which does feature in the portfolio. The detractors, which obviously outweighed the contributions to returns in the absolute sense, were of course those local companies that I've mentioned before, companies such as Stefanuti Stocks, HCI, which is of course Hoskin Consolidated Investments, very much focused on the domestic gaming and leisure industry, Avenge, Clientele, Lewis, and those sorts of names which came under a bit of pressure during the first quarter. In terms of the changes during the quarter, we took advantage of some of that price performance on the resources side and certainly in the platinum side to reduce our exposure a little bit. And we also increased our exposure to some of those names which came under pressure. For example, we actually increased our allocation to Lewis Stores. This share is actually so cheap that it's trading below its net current asset value. What that means is that if you take its current assets, so excluding all long-term assets such as property, goodwill and the like, and you subtract all liabilities from that number, including your long-term and your short-term liabilities, the share price is actually trading below that. Now that net current asset value is a proxy for a liquidation value, which tells you how extraordinarily cheap the company is trading at. That is very much a feature across our portfolio. Lewis is also a company which has a very small market cap relative to the large caps. It's about a 2.5 billion rand market cap company. That opportunity, even trading at those extraordinary levels, is simply not available to the larger asset managers, particularly if you happen to be value oriented. And so the current market environment plays quite nicely to what we believe our main competitive advantage is, which is our size along with our style. So being a smaller value manager, we have a wonderful opportunity set, which includes not only the large caps where we see value, but right through to the small caps as well. And if you look at the breakdown of this portfolio, in fact, half of the stocks in the equity portfolio are actually small and mid caps. In fact, 30% are small caps. Now, if you compare that to the All Share Index, which has about 3%, 3 to 5% in the small cap space, you can see then why our portfolio performs so differently or behaves so differently to the more benchmark-oriented managers who would have a similar amount of exposure to small caps as the All Share Index. So I think the fact that we have the willingness to invest in these undervalued situations, such as Lewis Stores, as well as the size advantage to be able to access those opportunities, does provide a very big opportunity for ourselves to actually take advantage of. So other shares which actually fit the profile of those value opportunities on the smaller scope are the Steinhoff Pref shares we hold in the portfolio. Those have actually subsequently been suspended. We bought them at 40 Rand. The face value is of course of 100 Rand. They pay an 8.50 Rand dividend per year. So if you look at that dividend on our purchase price of 40, you're getting an annual yield of 21%. It's a cumulative dividend, which actually gets its cash flows from the local side of the Steinhoff situation, which of course are the more healthy operations at this point, the likes of PEP and CUP. And it actually sits between the obligation that the local businesses have to the offshore businesses. So we've actually been collecting that dividend very happily, but there is a good chance that they may seek to actually pay back that debt and redeem those preference shares. So even if we take a haircut on that 100 Rand face value, that could result in significant capital gains from our purchase price of 40 Rand. And that is actually a top 10 position in our fund, which is a very good example. It's a 1.5 billion Rand market cap, just simply not available to the larger asset managers. Stefanuti Stocks is another example that has a market cap of only about 500 million. This is of course one of the very few construction businesses which still survives. Of course you will have read in the news headlines the various business failures, more latterly of Group 5. And Stefanuti Stocks, although it's been sort of going a bit sideways over the last few years, it is actually still profitable. And you can buy it at the moment on about a 3 PE, in other words, 3 times the historic yearly earnings, which is extraordinarily cheap. If you sort of by comparison consider that the average company you would buy at about 12 to 13 times the annual earnings, you can see that this is an extraordinarily low price for a business that is in fact still profitable during very tough times. So these situations, all of these smaller businesses which are presenting extraordinary value, limited downside by virtue of being priced so cheaply relative to their tangible assets or their net current asset value, or indeed sort of their liquidation value, or relative to the historic earnings even, on whichever basis you look, the downside is somewhat limited by the fact that they're trading at such low valuation multiples, whereas there is substantial upside, particularly if things turn out to be even slightly better than expected on the local economic front. And I think that is exactly where our portfolios are very well positioned, stacking the odds in favor of significant upside with limited downside. And that is indeed what protected the portfolios last year, where the portfolio held its ground, where most other funds in the marketplace were down substantially along with the market. We've also continued to build our basket of net nets. Lewis is one of those situations, so I will have described where the share price is actually trading below liquidation value, if you like. We basically are collecting very small positions in those types of situations in a basket situation, where again the odds are stacked in your favor of upside with limited downside, and a spin-off basket. Now the spin-off basket, I will have explained during the last quarterly comment, is basically also a collection of a value situation. Now this is not available. The net situation and the spin-off situation is again limited to asset managers that are small enough to take advantage of this. It is a well-documented empirical source of returns on the value front. And the spin-offs basically consists of those stocks which you purchase 2 or 3 months after they've been spun off from the parent company. Typically, the assets which are spun off are the less desirable assets. They're perhaps not doing so well, and in essence, the holders of the parent company stock get this spin-off stock, and essentially you are basically giving stock to someone who does not necessarily want to hold it, where it might be a negligible part of their portfolio, where it is not the part of the group that they're actually interested in, and their typical reaction is to sell those stocks. That creates downward pressure, which one can take advantage of if you step in at that point and then just hold those spun-off counters for approximately 2 or 3 years, and you just keep collecting those situations. So I think overall this portfolio represents a very interesting, eclectic mix of value opportunities, undervalued companies, where downside is limited, where the drivers of the returns for all of these businesses is varied, and where the portfolio is not dependent on one particular investment theme being proven to be correct within a particular space of time to drive returns forward. Over the last 3 years, the fund has continued to do very well. It has delivered 7.5% per year versus the all shares 5.7% per year. We believe that it's still early days in terms of that shift back to the value style outperforming, and we expect this portfolio to continue to be very robust in times of market decline.